Could passive investing be the reason you're not beating the S&P 500? Welcome to the program You Can Surpass the Stock Market. Here I show you how you can reach the peak where few arrive in the stock market without getting overwhelmed. I am Francisco and I'm an expert in finding stocks that can top the S&P 500. Passive stock investing is a popular strategy where investors put their money into index funds or ETFs that mimic the performance of a market index like the S&P 500. It's often touted as a low-risk, hands-off approach to growing your wealth. But is it really the best option for everyone? Passive investing involves buying a broad selection of stocks and holding them for the long term, with minimal trading and adjustments. In contrast, active stock investing is a hands-on approach where investors actively select stocks to buy and sell, aiming to outperform the market. This strategy involves thorough research, analysis, and timing to capitalize on market opportunities and trends. Active stock investing empowers you to outperform the market by making strategic decisions and capitalizing on high potential opportunities. The benefits of active investing include the potential for higher returns, more control over your investment portfolio, and the ability to adapt quickly to market changes. In particular, value investing is a powerful example of an active strategy. Value investing is a strategy that involves seeking out undervalued stocks with strong fundamentals that are currently out of favor in the market. This approach is rooted in the belief that the market often overreacts to good and bad news, causing stock prices to fluctuate beyond their intrinsic value. By identifying and investing in these undervalued stocks, value investors aim to profit from the market's tendency to correct itself over time. A prime example of this strategy is Warren Buffett's investment philosophy. Buffett, often referred to as one of the most successful investors of all time, focuses on buying high quality companies at a fair price. He looks for businesses with strong earnings, robust financial health, and competitive advantages that are temporarily undervalued by the market. His famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price," encapsulates this approach. Buffett's investments in companies like Coca-Cola, American Express, and Apple demonstrated the power of value investing. By purchasing shares in these businesses when they were undervalued, he capitalized on their long term growth potential and strong fundamentals. Value investing requires patience, discipline, and thorough research, but it offers the potential for substantial returns by uncovering hidden gems in the market. Overall, value investing is about making informed decisions based on the intrinsic value of a company rather than following short term market trends. It provides a path to achieving consistent, long term growth by focusing on the enduring strength of quality companies. While value investing emphasizes the stability and reliability of established companies, growth investing is a dynamic strategy that focuses on targeting companies with high growth potential, often in emerging industries. Investors who follow this approach seek out businesses that are expected to grow at an above average rate compared to other companies in the market. The goal is to find the future leaders, companies that are poised to expand rapidly and deliver substantial returns over time. A prime example of successful growth investing can be seen with tech giants like Amazon and Tesla. Early investors in these companies recognized their potential to disrupt existing markets and create new opportunities. Amazon, once a small online bookstore, leveraged its innovative approach to e commerce to become a global leader in retail and cloud computing. Similarly, Tesla's groundbreaking advancements in electric vehicles and renewable energy positioned it as a key player in the automotive and energy sectors. Growth investors often look for companies with unique products or services, strong competitive advantages, and a robust pipeline of innovations. These companies are typically in sectors such as technology, biotechnology, renewable energy, and other cutting edge fields. While growth investing can offer significant rewards, it also comes with higher risks due to the volatility and uncertainty associated with emerging industries. To mitigate these risks, growth investors conduct thorough research, analyzing factors like revenue growth, profit margins, and market trends. By focusing on companies with strong fundamentals and promising growth trajectories, investors can capitalize on the potential for exceptional returns. Growth investing requires a keen eye for future opportunities and willingness to embrace the risks and rewards of rapidly evolving markets. While growth investing seeks out companies with high potential in rapidly evolving markets, contrarian investing is a strategy that involves going against prevailing market trends and buying stocks that others are selling. This approach is based on the belief that the market often overreacts to news and events, leading to mispriced stocks. By purchasing shares that are currently out of favor, contrarian investors aim to profit from the eventual market correction when the true value of the stocks is recognized. One key principle of contrarian investing is to look for opportunities during market downturns. When the market is experiencing widespread pessimism, many investors tend to sell off their holdings, driving prices down. This creates a fertile ground for contrarian investors to find valuable stocks at bargain prices. For example, during economic recessions or industry specific downturns, high quality companies may see their stock prices decline sharply despite having strong fundamentals. By investing in these companies when their prices are low, contrarians can potentially reap significant rewards when the market recovers. Warren Buffett, one of the most famous contrarian investors, often emphasizes the importance of being fearful when others are greedy and greedy when others are fearful. This mindset encapsulates the essence of contrarian investing, which requires a high level of conviction and the ability to withstand short term volatility in pursuit of long term gains. Contrarian investing demands thorough research, patience, and the courage to go against the crowd. It offers the potential for substantial returns by capitalizing on market inefficiencies and mispricings. By identifying undervalued stocks that others are selling, contrarian investors can position themselves for success when the market sentiment shifts. Similarly, dividend investing is a strategy that focuses on selecting stocks that pay high dividends. Similarly, dividend investing is a strategy that focuses on selecting stocks that pay high dividends, providing a steady and reliable income stream for investors. This approach is particularly appealing to those seeking regular income, such as retirees or individuals looking to supplement their earnings. By investing in dividend paying stocks, investors can benefit from both the potential for capital appreciation and the consistent income generated by dividend payments. One key aspect of dividend investing is building a portfolio of dividend aristocrats. These are companies that have a long history of not only paying dividends but also increasing their payouts year after year. Examples of dividend aristocrats include blue chip companies like Procter and Gamble, Johnson and Johnson, and Coca-Cola. These firms are known for their financial stability, strong cash flows, and commitment to returning value to shareholders through regular dividend increases. Dividend investing offers several advantages. It provides a cushion against market volatility, as dividend payments can help offset declines in stock prices. Additionally, reinvesting dividends can significantly boost the overall returns of a portfolio through the power of compounding. For long term investors, dividend growth stocks can be an excellent way to build wealth steadily over time. To succeed in dividend investing, investors should conduct thorough research to identify companies with strong fundamentals, solid earnings growth, and a track record of consistent dividend payments. By focusing on high quality dividend paying stocks, investors can create a diversified portfolio that not only generates regular income but also has the potential for long term capital appreciation. This strategy combines the best of both worlds, offering stability and growth to help investors achieve their financial goals. Just as dividend investing offers a balanced approach to achieving both stability and growth, sector rotation is an investment strategy that involves shifting investments between different sectors of the economy based on the phases of the economic cycle. This approach aims to capitalize on the varying performance of different sectors during different stages of economic growth, recession, recovery, and expansion by moving investments into sectors that are expected to outperform during specific economic conditions. Investors can enhance their portfolio returns and mitigate risks. For example, during the oil boom, the energy sector often experiences significant growth due to increased demand for oil related products. Investors practicing sector rotation would move funds into energy stocks to take advantage of the sector's upward momentum. This shift allows them to benefit from rising stock prices and improved financial performance of energy companies. Similarly, during economic downturns or periods of market instability, defensive sectors such as healthcare, utilities, and consumer staples tend to perform better as they provide essential goods and services that remain in demand regardless of economic conditions. By reallocating investments to these sectors, investors can protect their portfolios from significant losses. Sector rotation requires continuous monitoring of economic indicators, market trends, and sector specific performance. Investors must stay informed about macroeconomic developments, such as changes in interest rates, inflation, and global economic events, to make timely decisions about sector allocation. Overall, sector rotation is a dynamic and proactive strategy that leverages the cyclical nature of the economy. By strategically shifting investments between sectors, investors can optimize their portfolios, capitalize on growth opportunities, and navigate market volatility more effectively. This approach helps investors achieve a balanced and diversified portfolio that adapts to changing economic conditions. Active investing can seem daunting, especially when compared to the steady ride of passive investing. But here's the thing, focusing on blue chip stocks can significantly mitigate those risks. Blue chip stocks are shares of well established financially sound companies with a history of reliable performance. Think of them as the giants of the stock market. Companies like Apple, Microsoft, and Coca Cola. These companies have strong balance sheets, consistent earnings, and a proven ability to weather market fluctuations. By investing in blue chip stocks, you are anchoring your portfolio with stability and quality. These are the companies that have been around for decades and have a track record of delivering value to shareholders, regardless of market conditions. Focusing on blue chip stocks doesn't mean you're playing it too safe. It means you're being smart about where you put your money. These stocks tend to be less volatile than smaller, less established companies, providing a more stable foundation for your investment strategy. Plus, many blue chip stocks pay dividends, offering a steady income stream in addition to potential capital appreciation. So, while active investing can carry higher risks, by centering your strategy around blue chip stocks, you reduce those risks significantly. This way, you are not just betting on any company, you're investing in industry leaders with a history of success. This approach offers the potential for growth and the reassurance that your investments are in capable hands. It's about making informed choices that align with your financial goals, reducing risk while still aiming for rewarding returns. With this solid foundation of blue chip stocks, it's also crucial to address concerns about the reliability of information, ensuring you make informed investment decisions based on accurate and trustworthy data. I totally understand the concern about the lack of reliable information. It can feel overwhelming with so much data and so much sources out there. But here's the good news: by using reputable sources and the right research tools, you can gather accurate and trustworthy information to make informed investment decisions. First, let's talk about reputable sources. Think of sources like financial news websites, industry reports, and analyst recommendations from well known financial institutions. Websites like Bloomberg, Reuters, and the Wall Street Journal provide up to date and reliable market news. They have a long standing reputation for accuracy and thorough reporting. Additionally, company annual reports and earnings calls are fantastic resources for getting a deep dive into a company's financial health straight from the source. Now, about research tools. Tools like stock screeners and market research platforms can be incredibly valuable. For instance, platforms like Morningstar, Yahoo Finance, and Seeking Alpha offer robust tools for analyzing stock performance, tracking market trends, and getting expert analysis. These tools can help you shift these tools can help you sift through the noise and focus on the data that matters most. By combining these sources and tools, you can build a solid foundation of reliable information. The key is to cross reference and verify the data you gather. This way, you minimize the risk of relying on inaccurate or biased information. Remember, the goal is to make informed and confident investment decisions, and with the right approach, you can achieve that. So, don't let the fear of unreliable information hold you back. Equip yourself with trusted sources and powerful tools, and you'll be well on your way to successful investing. Armed with reliable information, you can confidently navigate the complexities of active investing, even if it initially seems overwhelming due to the perceived need for high expertise. But here's a straightforward way to ease into it. Start with a small portion of your portfolio and gradually increase as you gain experience. Starting small means you are not throwing all your eggs into one basket. Allocate a manageable portion of your investments to active trading, something you are comfortable with, say 5 to 10%. This way, any potential losses are contained and it gives you room to learn without significant risk. As you begin, focus on learning the basics. Utilize resources like financial news, investment courses, and market analysis tools to build your knowledge. Don't be afraid to make mistakes. They're part of the learning process. Track your progress, review your trades, and understand what worked and what didn't. Gradually, as you become more confident and knowledgeable, you can start increasing your active investments. This phased approach allows you to develop your expertise over time, making informed decisions without feeling overwhelmed. Think of it like learning to drive. You don't hit the freeway on your first lesson. You start in a parking lot, then move to quiet streets, and finally, you're navigating highways with ease. Active investing is similar. Start small, learn the ropes, and before you know it, you'll be making more significant investment decisions with confidence. Remember, expertise doesn't come overnight. It's a gradual process. By starting small and increasing your investments as you gain experience, you can manage risks and build a solid foundation for active investing success. This approach makes the whole process more approachable and less intimidating. With this foundational understanding and gradual approach to building expertise, it's also crucial to recognize the limitations of over relying on index funds without diversifying. Relying solely on index funds without diversifying might seem like a safe bet, especially for those looking for a hands off approach. However, this strategy can limit your growth potential and expose you to market downturns. Let me explain why this happens and how you can strike a better balance. When you invest heavily in index funds, you're essentially buying a broad swath of the market. Index funds like those tracking the S&P 500 aim to mirror the performance of a specific market index. While this provides diversification across various sectors and companies, it also means your returns are tied to the overall market performance. In times of market stability and growth, this can work well, but it also means you're riding the highs and lows of the entire market. The primary issue with over relying on index funds is limited growth potential. Since index funds aim to match the market, they can't outperform it. If you want to achieve higher returns, you'll need to look beyond just mirroring the market. Additionally, during market downturns, index funds will reflect those losses, potentially impacting your portfolio more than if you had a more diversified strategy. So, what's the right way to approach this? The key is to combine index funds with individual stock picks for better diversification. By adding individual stocks to your portfolio, you can target specific companies with a high growth potential or strong fundamentals that may not be as prominent in an index fund. This strategy allows you to tailor your investments to your financial goals and risk tolerance. For example, let's say you're interested in the technology sector. While an index fund might include tech stocks, it's mixed with a variety of other sectors. By picking individual tech stocks, you can invest more heavily in companies you believe in, like those leading innovation in artificial intelligence or renewable energy. This approach can help you achieve high returns if these companies outperform the broader market. Combining index funds with individual stock picks also helps manage risk. Index funds provide a solid foundation, spreading your investment across multiple sectors and reducing the impact of a poor performance from any single company. Meanwhile, individual stocks allow you to capitalize on specific opportunities and trends. This balanced strategy maximizes growth opportunities while managing risks effectively. You get the best of both worlds, the stability and diversification of index funds, coupled with the potential for higher returns from individual stock investments. It's like having a safety net while also reaching for higher gains. In essence, over relying on index funds can leave you exposed to market fluctuations and limit your growth. By diversifying with individual stock picks, you can navigate the market more strategically, balancing stability with potential for greater returns. This approach empowers you to take control of your investments and align them with your financial goals, ultimately leading to a more robust and resilient portfolio. So, don't settle for just tracking the market. Aim to surpass it by combining the strengths of both index funds and individual stocks. In addition to diversifying with individual stock picks, it's equally important to avoid holding on to underperforming stocks indefinitely, because although it might seem like a show of patience or faith in a company's turnaround, in reality, it can drag down your overall portfolio performance. Let me walk you through why this approach can be detrimental and how you can adopt a more effective strategy through regular review and rebalancing. Picture this. You've invested in a stock with high hopes, but over time, it just isn't living up to expectations. Maybe it's continually missing earnings forecasts, losing market share, or its sector is facing headwinds. Holding on to such underperforming stocks indefinitely can erode your gains from other better performing investments. It's like carrying extra weight on a hike. The more you hold on to it, the harder it is to reach your destination. The key consequence here is that these laggard stocks can drag down your overall portfolio performance. This isn't just about missed growth opportunities, but also the negative psychological impact. Seeing a perpetual underperformer can be disheartening and may affect your confidence in other investment decisions. So, what's the right way to handle this? The answer lies in regularly reviewing and rebalancing your portfolio. This proactive approach involves periodically assessing your holdings and making adjustments to ensure they align with your financial goals and the current market environment. By doing so, you can weed out the underperformers and reallocate that capital into more promising opportunities. Reviewing your portfolio regularly means setting aside time, perhaps quarterly or biannually, to evaluate the performance of each investment. Look at key indicators such as revenue growth, profit margins, competitive positioning, and broader market trends. This analysis helps you make informed decisions about which stocks to hold onto and which to let go. Rebalancing, on the other hand, involves adjusting your asset allocation back to your target mix. For instance, if you initially set a goal to have 60% of your investments in stocks and 40% in bonds, but market movements have shifted that to 70% stocks and 30% bonds, rebalancing means selling some stocks and buying bonds to get back to your original allocation. This ensures that your portfolio remains aligned with your risk tolerance and investment objectives. The benefits of this approach are significant. By reviewing and rebalancing, you can maximize growth opportunities while managing risk. It ensures that your investments are in sync with your financial goals, rather than being driven by inertia. This disciplined strategy helps you stay focused on your long term objectives rather than getting sidetracked by short term market fluctuations. Ultimately, holding on to underperforming stocks indefinitely can be a costly mistake. Instead, adopt a habit of review and rebalancing. This way, you keep your portfolio dynamic and responsive to changes, ensuring it remains on track to meet your financial aspirations. It's about making thoughtful, informed adjustments that enhance your investment success and help you achieve your goals. So don't let a few stragglers hold you back. Keep your portfolio in top shape by reviewing and rebalancing. Similarly, ignoring market trends and economic indicators is like flying blind. It's easy to overlook their importance, but doing so can cause you to miss out on optimizing your portfolio. Let's chat about why this is crucial and how staying informed can make a big difference. When you ignore market trends and economic indicators, you're essentially investing without a map. These indicators, like GDP growth, inflation rates, and employment data, give you a snapshot of the economic landscape. They help you understand what sectors are thriving and which ones might be struggling. If you're not paying attention, you might find yourself over-invested in areas that are set to underperform, missing out on sectors that are poised for growth. The consequence? You could end up with a portfolio that underperforms simply because you didn't adjust to changing economic environment. For example, if you ignore signals of an impending recession, you might remain heavily invested in cyclical stocks that get hit hardest during downturns. Conversely, during periods of economic growth, Missing the cues could mean not capitalizing on opportunities in booming sectors like technology or consumer discretionary. The right way is to stay informed and adjust your investments based on current market conditions. This doesn't mean reacting to every news headline, but rather using significant economic indicators to guide your investment strategy. Regularly review financial news, economic reports, and market analysis. This way, you can make informed decisions about where to allocate your funds, ensuring that your portfolio is well positioned to take advantage of market cycles. Staying informed enhances your returns by allowing you to capitalize on opportunities and avoid potential pitfalls. By aligning your investments with prevailing market trends and economic conditions, you can achieve a balanced and diversified portfolio that's optimized for growth. It's about being proactive and responsive, ensuring that your investments are always in tune with the broader economic picture. So, keep your eyes and ears open to the market signals and let them guide your investment journey. Similarly, blindly following popular investment advice is a common pitfall that many investors fall into. It's easy to get caught up in the hype, especially when everyone seems to be jumping on the bandwagon of the latest hot stock or market trend. But let me explain why this approach can be risky and how you can create a more tailored investment strategy by conducting your own research. When you follow popular investment advice without doing your own homework, you expose yourself to the risks of a herd mentality. Herd mentality occurs when people follow the actions of a larger group, often ignoring their own analysis and instincts. This can lead to buying at market highs when stocks are overpriced, or selling during panic induced market downturns, locking in losses instead of weathering the storm. Essentially, you're letting the crowd dictate your investment decisions, which can be detrimental to your financial health. The consequence? The consequence of this is that you might end up with a portfolio that doesn't align with your financial goals or risk tolerance. You could be investing in assets that aren't the best fit for you simply because they're popular at the moment. This approach lacks the personalized touch that's crucial for long term success in investing. So, what's the right way to go about it? Conduct your own research and make informed decisions. This means taking the time to understand the fundamentals of the investments you are considering. Look into company financials, industry trends, and economic indicators. Use reputable sources and analysis tools to gather data and form your own opinions. By doing your own research, you can build a customized investment strategy that's tailored to your specific needs and goals. You're not just going with the flow, you're making decisions based on solid information and analysis. This approach helps you avoid the pitfalls of a herd mentality and makes your portfolio more resilient to market volatility. Joining an investment community is a fantastic way to enhance your investing journey. Picture it as a vibrant hub where you can connect with like minded individuals who share your passion for investing. Whether it's through online forums, social media groups, or local investment clubs, these communities offer a wealth of knowledge and support. Engaging with other active investors allows you to share insights and learn from their experiences. You'll find seasoned investors who have weathered various market conditions and can offer valuable advice. Their stories and strategies can provide you with fresh perspectives and innovative approaches to managing your portfolio. Moreover, being part of an investment community keeps you motivated. It's easy to get discouraged when facing market downturns or uncertain economic times, but having a network of supportive peers can help you stay focused on your long term goals. You can discuss the latest market trends, explore new investment opportunities, and even participate in friendly competitions to see who can achieve the best returns. In essence, joining an investment community enriches your investment experience. It's about building connections, continuously learning, and stay inspired. So, dive into these communities and you'll find that investing becomes not just a solitary activity, but a shared journey full of learning and growth. If you found this video helpful, make sure to subscribe to my channel and hit the notification bell so you never miss an update. Let's continue to learn and grow together, and I'll show you how to top the S&P 500 and achieve your financial goals.